In our previous video, we did look at the reasons why the 500,000 mark accelerates your financial growth, while at their millionth mark, your net worth skyrockets. In attempt to look at all that, we came up with the acronym growth from financial growth, and we used that word to denote several important things that are very vital in your financial growth for financial freedom. The G stood for control. We say that you need to gain control over your finances through the use of budget, expense trackers. R stood for your investments. Where having control over your finances, then that is where you root your investments, while O stood for your tax optimizations, looking for ways through which you can avoid paying taxes, thereby increasing your disposable incomes towards investments. Then we had W that stood for debts. And the reason why you need to weed out unnecessary consumer debts and purpose of using debt as a way of creating assets for your wealth. Then we had T that represented multiple income streams, and we agreed that you need to source for or tap into systems that give you multiple income streams to reduce the risk of reliance on one income. Then lastly, we had H that stands for your discipline. Discipline in your financial matters. Adopting and sticking to a regular pattern on dealing with your money with a vision or goal that is supposed to be achieved through your discipline in sticking to G for your control. All that is supposed to contribute towards your financial freedom by building a pool of assets that will now become your wealth. And it is these assets that are supposed now to be feeding or financing your lifestyle, financing your aspirations, financing your security concerns, and also your legacy. Today we are looking or we are diving to look at this big word asset, because asset as a term has been used ambiguously. And loosely, it has only been said that assets are things that put money in your pocket, while on the other side, whatever takes money out of your pocket is a liability. But that does not exhaust what assets are, and for that reason, we are getting so many questions on whether my house is an asset, whether my car is an asset. Looking to broaden the scope about assets and understanding why in personal finance we decant all that and we remain with the definition that an asset should be able to put money in your pocket, while a liability is what is taking money out of your pocket. And because at the very bottom line, cash or cash flow is what is important. Cash is key in personal finance. It is cash that we use to settle our expenses. It is cash that we use to finance our lifestyle. Therefore, having assets is different from having cash, although cash is a consequence of your assets and assets is your wealth. So, the broader definition of an asset from a finance professional perspective, an asset is anything that you own or have control over, which has an economic value, a measurable value, and can generate an income or a future economic gain or profit. From that, we can identify three criteria that you are going to be using in determining what is an asset. And the three are: number one, it should be something that you own or control. Number two, it should have a measurable value. And number three, which is important, it should be able to generate an income, a profit, or a gain. But to expand on that definition, for inclusivity of all what entails an asset for accounting perspective, because that is very important, is an asset on the part of being able to generate an income, we also include or used to protect other assets that are generating income or facilitate in the generation of the income. And a good example would be when we are classifying assets for purposes of accounting for business, we look at the building, then we have the machines that are within the building, housed by the building, and it is these machines that are converting the raw materials, which are part of inventories, into goods or commodities for sale, while the same commodities, when sold, they still form part of inventory. And once sold, they get converted into cash, which also forms another asset. So you can convert one form of asset through a process adding value into another type of asset and back to original assets. You have a raw material, convert into stocks or items which have attained value for sale, convert those items to cash, where the raw material, the inventory in store, and cash, they are all assets. But the most important aspect is looking the building that protects or houses the machines is also an asset. It is facilitating, protecting the other resources that we are using to produce the sellable products. And that's why in accounting we talk of the PPE, property, plant, and equipment, as assets. If you are to approach a bank for a loan facility, you'll be required to list your assets. And the most common that we will go for, and it's right, is your private car, then your building or your house. Then the next will be a plot in the middle of nowhere. Then you can go for whatever other item that you are holding, which has a measurable value and the potential to generate an income. So assets in generality, assets is anything that you are owning or you are controlling that has value, measurable value, and can be used to generate an income as that potential. Once we have that general definition and those three criteria of determining what an asset is, then we look at the different bases of classification of assets. After 3 seconds short break, so don't go away. In the meantime, give us a like to the video, engage in the comment section, or let's continue talking about assets in the comment section, and see you after 3 seconds short break. Welcome back to our continuation on assets. Assets are divided in numerous classes on specific basis. The first one will look at their physical nature, and we shall classify assets into tangible and intangible assets. Where tangible assets are the ones that have physical existence. We can interact with them, we can touch them, we can feel them. A good example is a building, a vehicle, a machine, cash or money, while the intangible assets are those resources that we own, we're in control of, but we cannot interact with them. We can't touch them, we can't feel them. And the first one, we can look an example of intangible asset as your knowledge, a brand, a patent, a franchise, your skill set. All those are assets. And on the classification of intangible and tangible assets, we can also classify assets on the basis of their intrinsic value, their true value. And that one would get to classify assets as financial assets and real assets. Where real assets are those ones which have an intrinsic value, a real value. You can be able to tell when they are undervalued, overvalued, and to inform your decision to invest. And a good example is when we are looking at the intrinsic value of a company in order to determine whether the stock or share of that company is overvalued, undervalued, to determine whether to invest or not. You can determine the intrinsic value, the true value of land by evaluation. You can determine the true value of a vehicle. On the other hand, we have financial assets. And these type of assets, they draw their value from contractual claims. And a good example is a bond and such like assets. The third classification, we can look at movable and immovable assets, or fixed assets and non-fixed assets. And just from the name of the assets, movable assets are the ones that you can commute from one point to another, while we have immovable assets like land and building that you cannot move. We have another very vital classification in the current and non-current assets, and that is on how easy or quick it is to convert that item back into cash. And in the case of a non-current assets, these are the ones that will take some time to convert them into cash. And a good example are the fixed assets or the movable assets like land and building. And we have the current assets, the ones that are near cash or easily convertible to cash. And near cash to mean, in other cases, sometimes we call them cash and cash equivalents for the cash, near cash item. Then we have others like stocks, which will take a shorter time to convert or sell them or liquidate them back to cash. Then we have a very important classification of assets, and this is the one that we may normally use under personal finance when we talk of assets as merely being those things that put money into your pocket. And in this classification, we are talking of idle assets and active assets. As idle assets are those assets. In the first place, we are calling them assets because they are, but idle because they are not generating money at the moment. They are not giving us cash flows. While on the other hand, the active assets are the ones that are giving us money, profits, incomes, or they are generating cash into our pocket. And that is what mostly cases has also been used to refer to as dead assets. Things that you are owning or you are controlling, they have a measurable value, but unfortunately at the moment, they are not giving us cash flows. They are not trafficking money into our pockets. It is in such cases now where we talk of a home that you build in the village that you are not using. That house and the land, something that you own and you can prove ownership of a title deed, you could be controlling, meaning that you have the permission to use it, but it belongs to another person. That is what control, how control comes in. It has a measurable value because once valued, it will give us a valuation, an economic value. But that home is not generating an income for you. The same as a vehicle. You are owning a vehicle which has a true value, you are owning it and you have a document logbook to prove your ownership, or if it's owned by another person, you are permitted to use it and therefore you are in control of it. It has the value, but unfortunately, it's not putting money in your pocket. That is to draw the fact that most of the assets or these items that we are owning that are not putting money in our pocket, in most cases, is because of lack of use in a manner that generates money. Because if I convert that home in my village and make it a rental property, rent it out to another person, it immediately starts generating money. So the aspect of the fact that an asset that I own is not putting money in my pocket at the moment does not make it an asset. I'm just avoiding using the term liability because the opposite of an asset would be a liability. It is an asset, but not giving me cash at the moment. That is very important because we have to admit in our collection of data on what forms assets around us. Before now, we narrow down to look at the reasons why whatever we are classifying as asset is not generating cash at the moment. Then that will delve into the next question: what can I do to make this asset that is not giving me money start generating cash flows into my pocket? Lastly, but very important, it's good we look at another fact. And I'm using example of our parents as a millennial, mostly for the millennials. We have our parents, or for many families or many people, we have to support the parents, not by mere fact of giving, but the parents rely on our incomes to support their lifestyles. And such parents, you still find them, they are very rich. They have a lot of tracts of land. They have so much of assets, but unfortunately, those assets are not generating cash flows. Land that they are not using, we also not using, and therefore an asset that is idle at the moment. That characteristic, or that is a quality that you will find with a lot of older parents, especially for the millennials. Important question at that point is, what is it that can be done to make to make use of these idle assets to generate incomes that can sustain this parent and possibly retain its value, preserve that capital, because at the end of the day, the greatest problem with most families in such a predicament or predisposition is that the children will not want the parents. The problem with the children is that they cannot allow the parents to dispose of their land for purposes of supporting their expenses, because the children are also looking at those parents' assets as their inheritance. But there are financial solutions that can be created that will serve to provide for the hedging parents to eliminate that old age poverty, and also serve to give an inheritance, a befitting inheritance to the children. And a good example is liquidating this land that is idle at the moment. If we cannot use it for agricultural activity, if we cannot lease it out to other people to use it and generate an income for the parent, we liquidate this land. Then once you have liquidated the land, the amounts that are realized from that disposal, we use that money to establish a portfolio, an investment that preserves the capital, the amount that we disposed, and grows it perhaps, and generates sufficient income to support the parents. And because the capital is preserved in this investment, it means once the parents are happily gone, then that form part of the estate that can be shared by the beneficiaries. A good example, let's use it as an example. An old parent who is asset rich but cash poor. Those words we use them to describe a person who has a lot of idle assets. A lot of assets that are not generating money. He has a plot somewhere, another old plot which is not occupied because it requires a lot of renovations and what have you, and there such properties, because those are assets and their collection is the wealth for this particular person, but because they are not generating cash, we classify that person as an asset rich person but cash poor. And that is what describes many older parents today. On the other side, we have taken an example, you dispose those assets. And a good, let's say an example, we realize an amount like 4 million. This 4 million, you take it and invest it. Put it into an investment vehicle that generates returns or incomes, be it in form of dividends, be it in form of profits, or what we get from special funds that you cannot classify as a dividend or interest, or but we generally call them incomes because it comes from many diverse assets, or we can call it an interest from a bond or a mutual fund. Then that income is distributed on a monthly basis to support the parent. And because this investment vehicle preserves that amount, the capital, the 4 million. And if the parents, what they are consuming is leaves a small percentage to grow that capital. Once these parents are gone, the 4 million, which would have now grown to maybe 8, 10 million, or whatever amount it would have grown into, but it will never have gone down below 4 million because of the investment vehicle preservation, then that will be available for distribution among the beneficiaries of such parents. Such scenarios, what you need as an individual is take a list of all what should be your assets. Then classify these into idle or active assets. Then ask yourself the questions on what can you do to the idle assets to make them start generating cash flows. And that is very important. It may not be very important at now for some people because they are still actively generating a lot of incomes that are enough to cover their living expenses and also provide enough for their investments. But as time goes by and you are attaining your freedom number, you would require to consolidate your assets and establish sufficient cash flows or estates or trusts that are able to stand in between when you choose to start enjoying your freedom. So that is basically the classification of assets and what entails assets without looking at some to classify them as liabilities when they are still assets. But we'll still look at what a liability is in our next video. Thank you for watching and see you in our next video.